So, this is about mutual fund versus ETFs. Which one should you pick? The introduction why this topic matters. This video matters because the millions invest in mutual funds, but only a fraction explore exchange traded funds. People follow influencers but don't understand how the products work. This video helps you build financial confidence to invest the right way. Most videos confuse viewers. This one gives you a clear decision roadmap. By the end, you will know exactly what suits your lifestyle, income, and goals. Basic definitions with visual goals. What is mutual fund? A mutual fund is a professionally managed pool of money from multiple investors. Fund managers picks assets like stocks, bonds, etc. as per fund objective. You don't need a demat account. Pricing based on net asset value, calculated once a day. Great for those who want a set it and forget it strategy. What is an ETF, exchange traded fund? A basket of securities like an index fund traded on the stock exchange. You buy, sell units like a stock during market hours. You need a demat plus trading account. Usually passive, example, Nifty 50 ETF mirrors the Nifty index. Good for those who want more control and lower cost. Simple analogy mutual fund is equal to Ola with a driver, whereas exchange traded fund is equal to self driving your own car. Key functional differences. Who manages the fund? Mutual fund, active or passive fund managers makes decisions. Exchange traded fund usually passive just mirrors the index. How is pricing done? Mutual fund based on NAV once a day, fixed price for the day. ETFs, prices changes every second like a stock. How do you invest? Mutual fund direct via AMC, app or aggregator. ETF through broker like Zeroda, Grow, Upstocks needs a demat. Minimum investment. Mutual fund rupees 100 to rupees 500 minimum SIP possible. ETFs you need to buy at least one unit. May cost rupees 180 to 200 plus per unit depending on market. Types and categories. Mutual fund types. Large cap funds for steady long term growth, mid or small cap funds for high growth, more risk, debt funds for low risk investors, senior citizens, for tax saving under Section 80C, balanced hybrid, mix of equity and debt. ETF types. Equity exchange traded funds. Examples are like Nifty 50, Nifty Next 50, Bank Nifty, gold ETFs, alternative to buying physical gold, debt ETFs, Bharat bond, safe, predictable returns, international ETFs, Nasdaq 100, S&P 500 exposure. Sectoral ETFs, pharma, FMCG, IT. Cost, charges, and hidden expenses. So the mutual funds expense ratio can go up to 2.5% in active funds. Exit load. So every mutual fund will have an exit load charged if withdrawn before lock in, like 1% for less than 12 months. Regular versus direct. Regular includes distributor commissions. It gives expense ratio very low as 0.05 to 0.2%, brokerage fees rupees 20 per order or free in some brokers. Demat charges annual AMC rupees 300 to rupees 700. Even a 1% extra expense ratio can reduce your coppers by lakhs over 10 plus years. Liquidity and trading differences. Mutual funds. Trades once per day, money credited in T plus 2 days post redemption, SIP automation available. So, exchange traded funds trade anytime during market hours, immediate liquidity if enough volume, SIP not available on most brokers, mutual investments. Taxation rules. For equity mutual funds and ETFs, short term capital gains less than 12 months, 15%. Long term capital gains greater than 12 months, 10% after rupees 1 lakh. For debt funds or debt ETFs, now taxed as per slab rate, no indexation, benefits post 2023. Dividend tax, no more dividend distribution tax, taxed as per your slab. Consider growth option over dividend if you are in 30% slab. Risk volatility and tracking error. Mutual fund risks. Market risk, fund manager underperformance, scheme mismanagement. ETF risks, tracking error, difference between index and fund returns. Liquidity issues, especially in low volume exchange traded funds. Short term volatility, price swings within a day. Real life investor scenarios. Salaried employee SIP of 5,000, best suited for mutual funds via SIP in large or mid cap. Retired senior citizen, debt mutual funds or Bharat bond ETF for capital protection plus income. Trader, DIY investor, build your own passive portfolio with three exchange traded funds, Nifty 50 plus Nasdaq 100 plus Gold ETF. Tax saving employee, choose ELSS over ETF for 1.5 lakhs. It is a tax benefit. Tools, platforms, and portfolio ideas. Mutual fund platforms, Zerodha, Coin, Grow, Paytm, Money, AMC websites. ETF platforms, Zerodha, Upstocks, Fires, Angel One. Portfolio templates, simple SIP portfolio, Access Blue Chip like Access Blue Chip, ICICI Mid Cap plus SBI Hybrid. ETF portfolio, Nifty 50 ETF, Bharat Bond ETF, Nasdaq 100 ETF. How to decide which is best for you? So this is a parameter, okay? How to decide which is best for you? Mutual funds and ETFs. Parameter is ease of use. Mutual funds are beginner friendly. ETF needs understanding. If you're a ease of use is means like in ETFs you need understanding. It's a beginner friendly because other fund manager will manage in the mutual fund. Cost higher in mutual fund, cost is higher. ETFs it's a lower cost. Flexibility, SIP, auto fees in mutual fund. So here it's manual in extended funds. Control, mutual fund low control because fund managers manage. ETFs you have to manage your own ETF. So it's a high control. Demat required, no in mutual fund, whereas in ETFs demat is required. Choose mutual fund if you are a beginner. You want to invest automatically via SIP. You don't want to monitor markets. Choose ETFs if you want control. If you want to control, you're cost conscious, you understand trading basics. So this is the end of the video. If you found value in the video, please give a thumbs up, share with others so that they can also get some value from the video. Also subscribe so that you can watch more videos. In the description, there is a link and register for my free webinar Transform Your Finances. Once you become my community members, there'll be a weekly meetings. Thank you.